Now, with this global pivot in rates, it appears to be getting clearer that the era of cheap money and easy money is over. How do you invest in this new environment? Joining us are Peter Boockvar, Chief Investment Officer at Bleakley Advisory and a CNBC contributor, and Jason Brady, President and CEO of Thornburg Investment Management. Welcome to both of you. Peter, I will start with you. How do you explain the past 24 hours?
That's a great question. I think that a confirmation of the synchronized mode of global tightening that we're experiencing. And as Steve said, the Swiss sort of came out of left field in a way that we weren't expecting it, but it's what they should be doing since they have the deepest negative interest rates in the world. So what we're now transitioning to is central banks that are now trying to wake up to reality, because before this, the bond market around the world was tightening for them. And this is an attempt for central banks to sort of get back in control of this whole inflation narrative. But now we're going to shift to what's the economic implications of all this. The Atlanta Fed, as we said, as was spoken, no growth in the second quarter. And we have to assume that there's a high likelihood that it could be negative in the second half, and that there is going to be a global recession likely upon us in response to inflation, in response to all this tightening. So that's where investor focus is now shifting towards. Where do earnings shake out in that kind of environment? And
where does that leave you, Jason, on the kinds of risk assets you want to own here? I mean, is fixed income now attractive because we've priced this in, or does it continue to be, a place of no return?
Well, look, on a day when Hormel is the only thing that's up, I would say if you only own spam in your portfolio right now, it's probably just as bad as only owning growth in your portfolio 5-6 months ago. It is absolutely the case that fixed income can play a role that it hadn't been able to play. Real rates on the 10-year space are up 2% from their lows, negative lows. And I'd also say that international equities are looking pretty interesting in the context of other central banks moving and therefore maybe taking out some of the strength of the dollar. So there is interesting things to do with money today. I expect a recession, frankly, but we're starting to price that in. And so I'll tell you, as I've said before, Kelly, I've bought the bottom before, but I've never only bought the bottom.
Right, exactly. Peter, what do you think about owning international equities versus U.S. equities?
We do like particularly Asian markets, and I do think today could be an interesting inflection point on the dollar, as was just mentioned. So the Swiss franc is having a very short move higher against the dollar in response to what they did, also against the euro. And it's potentially technically a double top in the dollar versus the Swissy. So I think if today's the beginning of the world realizing that other central banks are finally taking this seriously, just as the Fed has, and that you're going to see a compression in interest rate spreads of overseas bonds relative to the U.S., that we could be marking the top in this dollar move. If that is going to be the case, then international markets should start to get some of their footing, or at least start to outperform U.S. markets from here.
Do Asian equities stand out to you, Jason? Where do you guys think has the opportunity?
We try at Thornburg to put together balanced portfolios. So certainly there are equities in Asia that are interesting. There's also equities globally that have exposure to Asia. We really like a European insurance name, NN Group, cheap, 10 times earnings, great cash flow, negligible exposure to Russia, Ukraine. It's got a good portion of our business in Japan. So I think it's time that investors really take a look at, what is the broader exposure. Pharma is another thing. AstraZeneca, great Asian exposure that's really going to be positive for them going forward. So you look at names that aren't necessarily the ones that are most beat up, but nor are they the ones we were hiding under a rock with. Great cash flow generation will fund growth. Make sure you have cash flow, and those names do, and lots of names in Asia do.
Citigroup even comes up on your screen, which is kind of a surprise to see. Peter, what would you do with the financials here, which are supposed to be a beneficiary of higher rates and yet have struggled mightily this year and now have to contend with stagflation?
Well, the money center banks in the U.S. are obviously having to deal with also a potential downturn in the capital markets as M&A dries up, IPOs dries up, SPACs dry up, and also the downside of a credit cycle. So I still think that that's going to be a tough place to be, whereas insurance companies can actually benefit directly from this rise in interest rates.
All right, and where would your final on metals, commodities? We're going to talk about a guest in just a moment who's seeing some bearish chart developments. What would you say of someone who thinks this one might actually be a multi-year bullish cycle?
Well, if I'm right that today maybe marks the peak in the dollar off that Swiss franc move, then I think that that can light a fire upwards in gold and silver.
All right, we'll see. We'll leave it there. Gentlemen, thank you so much today. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.